This is an Uncovered Japan company research report on Kagome, ticker 2811. Kagome may be best known for ketchup, but it is better understood as a 126-year-old vegetable company. It breeds tomato varieties, organizes farming, processes tomato paste, sells branded juices and condiments, and reaches customers in Japan and abroad. The investment question is whether that unusually integrated model can produce steadier returns than the market expects. At the report date, Kagome traded at 18.2 times forward earnings and 1.29 times book value, with a 2.14% dividend yield. Those headline multiples look modest against large Japanese food peers, but the company earned only 7.9% return on equity in fiscal 2025. That gap between a strong consumer franchise and a modest return profile is the central valuation tension. Kagome's product model is easy to miss if you only see a bottle of ketchup or vegetable juice. The company operates across the value chain: proprietary genetics, contract farming and fields, primary tomato paste processing, then branded beverages and condiments. That structure can capture both upstream processing economics and downstream brand value. But when tomato paste prices fall, Kagome feels the cycle in its processing margin and in agricultural inventory. The three segments are not economically equal. Domestic processed foods account for 54% of sales and generated a 9.75% business profit margin in fiscal 2025. It contains vegetable juice, ketchup, sauces, and direct-to-consumer products. International, at 39% of sales, contains tomato paste and local condiments. Its margin was lower at 7.99%, and its external sales and profit move with the global paste cycle. 5-year revenue growth can make Kagome look faster than it is. Revenue rose from 224.7 billion yen in fiscal 2023 to 306.9 billion in fiscal 2024, largely because Kagome raised its stake in U.S. paste producer Ingomar and consolidated it. Fiscal 2025 revenue then fell to 294.3 billion yen. Recurring business profit fell from 27.1 to 22.4 billion yen as the tomato paste market weakened. The balance sheet is sound rather than stretched. Kagome ended fiscal 2025 with a 50.7% equity ratio and 190.6 billion yen of owner's equity. The distinctive feature is 119.4 billion yen of inventory, roughly 32% of total assets. Tomatoes are harvested, processed into paste, and held for months, so inventory is an operating necessity. It is also why return on equity remains modest and why commodity turns matter so much. Kagome's cash flow can look erratic in a single year because inventory follows the harvest and paste cycle. Free cash flow was negative during the fiscal 2022 and 2023 inventory build, then recovered as inventory unwound. Fiscal 2025 free cash flow was 15.4 billion yen. The important distinction is between a working capital cycle and permanent cash leakage. The report views the current balance sheet as manageable, while still demanding better capital efficiency. Kagome's moat has three connected pieces. First, proprietary genetics and breeding improve yield, flavor, and processing characteristics. Second, owned primary processing in the United States, Portugal, and Australia offers supply security and traceability. Third, the Kagome name is deeply associated with convenient vegetable intake in Japan, supporting price increases and customer trust. The limitation is clear. A powerful integrated chain still cannot control a global commodity price. Management's plan is explicit. By fiscal 2028, Kagome targets 27 billion yen of business profit and return on equity above 9%. Its longer vision 2035 aims for 500 billion yen of revenue. The financial bottleneck is the international operation. It must turn a volatile tomato processing business into a more stable margin engine through product mix, automation, and operating discipline. That is the strategic proof point behind any re-rating. Against large food peers, Kagome screens inexpensive. Its 18.2 times forward earnings is about 3/4 of the peer median, while its price-to-book ratio is about 2/3. But the report does not call that a simple mispricing. A 7.9% return on equity merits a lower multiple than high-return names such as Ajinomoto or Kikkoman. The stock appears reasonable to slightly cheap, not a deep bargain. The report's 3-year scenario range makes the dependency visible. The base case reaches 3,058 yen, about 13% above the report date price, assuming international markets stabilize and domestic price increases hold. The bear case 1,914 yen, assumes another margin shock and domestic volume pressure. The bull case needs an upturn in tomato paste and sustained margin improvement. These are analytical scenarios, not price targets or recommendations. Kagome combines a defensible Japanese vegetable brand, rare seed-to-shelf integration, and a healthy balance sheet. The trade-off is a low-return, inventory-heavy business whose international earnings still follow the tomato paste cycle. For investors, the questions are specific. Can international margins hold through a down cycle? And can management lift return on equity above 9%? Those are the metrics that would change the valuation story. For a much deeper look, visit the free deep dives at uncoveredjapan.com. We go beyond the headline numbers to cover the business, financials, valuation, risks, and catalysts. This video is for information and education only. It is not investment advice or a recommendation to buy or sell any security. Always do your own research.